a very special interaction after the poll verdict. We are joined by Neelkanth Mishra. He is the chief economist of Axis Bank and head of global research at Axis Capital. Thanks very much for your time and for this interaction. I'd like to begin by asking you your top 5 suggestions for the new government that is set to take charge.
No, thank you for having me here. I think there are the fact that there is continuity in the government is very welcome. As you know, many of the changes that occur at the central government level take time to enact and execute. And for example, even implementing a new law requires that a new law be drafted. It takes time. Then it is presented in the parliament. There is a standing committee that it goes to. So there are many such regulations, many such changes which are underway, and I think we should see continuity in that front. If I was putting on a prescriptive hat instead of a predictive hat, which generally I do as a market participant, I would think that the most important action for the government going forward would be how to change itself or how to change procedures and so that there can be much faster action on industrial policy. The global operating environment has changed very meaningfully, especially in the last 5 years. And with China being very active on industrial policy, significant amounts of subsidies, cheap loans being given to industry, and there being a reaction from the US and Europe, I think India also on specific and critical sectors needs to be a lot more active than it has been. And structuring the government such that it can deliver very rapidly on some of these measures should be a very high priority. The second big priority should be urban infrastructure. The real estate cycle, the return or the revival of the real estate cycle is the reason that the economy is reviving. So between 2012 and 21, the real estate cycle was turning down. Now it is turning up. The good thing is when it turns up, it stays up for a while. But for it to last 10, 12 years or 15 years instead of say 3 to 5 years, we need to significantly enhance urban infrastructure, urban management. And for that, there needs to be work done perhaps at the GST Council, perhaps with the Finance Commission, perhaps at the fiscal level, where more funds need to be made available to directly to improve the infrastructure so that the real estate cycle and the housing markets can stay buoyant. I also think that sticking to the fiscal consolidation roadmap is very important. This is something that the government has done wonderfully well in the past 5-7 years. And I think that, and my expectation is, and here I put on a predictive hat as well, that despite what many think is going to drive a change in the government's fiscal stance, I don't think the government is necessarily going to revise its fiscal consolidation roadmap, and that in many ways would be a prescription for me as well. Another point which I think warrants immediate attention is a simplification of GST. So it is imminent, or some changes have to be made because the requirement of the compensation cess, which was required in the early years to pay compensation to states to guarantee them their 14% growth. Now that phase is over. Even the backlog has now been cleared. So as the GST Council contemplates what to do with the various parts of the compensation cess, I think it's a great opportunity to significantly simplify the GST rate structures. When it was earlier envisaged, it was supposed to have 1 or 2 rates at max. Right now, it has, I think, 6 or 7 rates. So it will be important to, I think, rationalize and streamline some of those changes. And lastly, on the direct taxes side, I think there is significant scope for accelerating the process of providing tax clarity to foreign firms which are looking at India for production, for moving parts of their value chain here. And the pace at which we can offer them clarity on taxes, if we accelerate that process, I think we can, and simplify that process, I think we can get more of them. And similarly, on the personal income taxes side, there is significant scope for simplification of the filings to reduce subjectivity and therefore to improve tax compliance, especially for the non-salaried personal income tax. So yeah, these would be the 5 major things that I would advise as an advisor.
All right. So will the pace of reforms change given that this is a coalition-led government? Many, of course, are making projections. What are your first thoughts and what do you think this will mean for Modi 3.0's reforms?
I don't see that as being necessarily changing meaningfully, meaning that, look, unlike some of the coalitions that we saw, say, in between 96 to 98, or even from 99 to 2004 to 2009, in this case, there is one party with 240 seats, and the other allies are much smaller. So while there may be some consensus view that may need to form on, and some document which sort of sets the agenda, but when it comes to the big and important decisions, I don't see any reason why that process should become unnecessarily complicated. See, one of the characteristics of regional parties is that their attention, their focus is primarily on using their central position to enhance their resilience or their presence within their home states, because that's where they draw their political power from. So a special category status to Andhra Pradesh, a special category status to Bihar, for example, those could be very high on the ask. But beyond that, generally regional parties do not see much benefit in trying to interfere with national level agendas. And frankly, even on things like the fiscal stance, there is not much to be gained by the regional parties on those fronts. So I don't expect this to be that disruptive. In fact, for most of the major ministries, the BJP should be holding on to, the BJP party members should be the ministers in most of the major ministries. So I don't expect this to necessarily slow down the process of government functioning. The process of reforms, remember that there are 3 levels of reforms, right? So there are constitutional amendments where you kind of change the contract between the citizen and the state in a way. There are legislative reforms where you start changing laws, and there are executive reforms or executive changes, decisions. Now, the constitutional amendments, of course, if the exit poll verdict had been right, perhaps some of those would have come into the realm of possibility. But now that's ruled out. But beyond that, for passing laws, any government, the whole reason for having a majority government and the constitution prescribing that is that you should be able to pass laws, and this government can pass laws. On the Rajya Sabha side, the NDA has close to 49% of the seats, and there are several, states they won. So Odisha, Andhra Pradesh, Rajya Sabha position should strengthen. Plus, there are other parties on the other side. Remember that the opposition is also an alliance, and there are several parties which are not in the alliance as well. And so getting issue-based support on some of those things it's not very difficult. So the government should still be able to pass laws, and that doesn't change too meaningfully in this process. There could be a period of consultation that, look, you build in that, look, this is the bill that we are presenting and we need your support on this. But beyond that, I don't see this as necessarily slowing things down. On the executive side, the way the government functions is that whether you have 100 seats or 250 or 300 or 350, the Prime Minister gets to decide on several things, and the Prime Minister will decide on several things. Whoever is the minister in a particular ministry has the executive authority on those ministries. That's how the government runs. So I don't see this as necessarily slowing down the pace of governance. In fact, the issues will be, or not the issues really, but the uncertainty would be what are the big priorities that the government drafts, and that has nothing to do with the number of seats that the winning party has.
Take us through the policies you feel will stand out in the next 5 years.
See, big changes at a central level in terms of, for example, if say the government was to be restructured, meaning that some ministries were combined, some departments were brought together so that India can collectively respond much better to industrial policy actions by the rest of the world. Those will, I think, over time, and the impact of those, I think they're very necessary. the impact, if done, would have affected economic growth beyond the next 5 years. But if you're thinking about the next 3 to 5 years, the wheels that have been set in motion, so basically the revival of the real estate sector, the fact that the fiscal consolidation roadmap, the economy is seeing, in fact, much stronger growth than what I had also expected when I put out some of those numbers. These are all signs that the underlying machinery, like the demand for power is going up. There's a lot of innovation happening. There's a lot of global capability centers. I think investments in technology are picking up. R&D capabilities are improving. In fact, what I would also strongly recommend in the first 5 steps that you said, maybe add a 6th one, which is that if India has to break through the middle income trap, which eventually it will hit, say in 15 years or 14, 15 years, it needs to start investing in research capabilities and product capabilities. And it is part of the BJP manifesto, how to make India a product nation. And that has to be, I think, also a very high priority. So those are things which are not politically contentious. In the early stages, they may not even require a significant amount of legislative change or even fiscal resources. But for example, reforming regulators is something that can happen very quickly. So so long as these things are happening, the 5, 10, 15-year growth track record starts to get affected. But for the next 3 to 5 years, I think it is sufficient that the real estate cycle keeps turning, and energy demand, and therefore demand for utilities and power generation and coal mining, etc., and renewable energy continues to see investment. If these 2 things keep happening, I think the Indian economy will be fine.
All right. What must India then aim to achieve over the next few years to implement all these ideas?
As I said, I think the government has explicitly stated that India needs to become a product nation. There needs to be a lot more of innovation. We are hearing from the new secretary on science and technology, the new the principal scientific advisor. So everyone is now aligned to that view, and I do think that the government over the next several months, if not years as well, will be setting interesting and exciting targets on what India should try to achieve. So, for example, why shouldn't India try to build its own airplane? If China can do it, should we have a target in the next 5 to 7 years that India should build its own airplane? And as you set these kind of targets, a lot of domestic capabilities start to get developed. So, for example, the Vande Bharat trains, the fact that India can manufacture those, there's been significant innovation in traction motors, in suspensions. So there's a lot that can happen. So that's one clear area where I think there is stated intent, and I would expect to see significant action. There are, I think, several other fronts, like as I said, indirect tax reform, direct tax reform, thinking, infrastructure, the implementation. So remember that economic growth often also depends on the quality of the infrastructure. So suppose, as the dedicated freight corridor, the various expressways that are under commissioning start to function, imagine the impact that they will have on logistics costs in India, and therefore India's manufacturing competitiveness. So, and then some of the projects that have been commissioned, say on the semiconductor side, the continued growth in electronics exports, some of these things, the new and fascinating layers will be built, right? So initially, there was a lot of suspicion and doubt and debate on whether India can really execute on the electronic side. But what we are seeing is a fascinating pace of delivery. And now the upstream ecosystems are emerging. So you will see India, I think, and I expect to see India becoming much more entrenched into global value chains on several fronts. We need to keep working hard towards that, but I think a lot of execution will likely focus on that as well.
Now, you have in the past been quoted saying that income and consumption inequality persists in India and may rise. You've said this could rise, so why do you say so? And how can India contain this?
So that, if you ask me, is the biggest, I would say, the policy challenge that exists for anyone who's governing India. Right? So if you take a step back, as to why inequality is up and rising and why most people, including me, think that it will perhaps likely to go up in the next coming few years. So there are cyclical issues and there are structural issues. The cyclical factors are linked to the fact that the economy is still not fully recovered from COVID, in the sense that versus the pre-pandemic path. So if you had drawn a trajectory for India's economic output as measured by GDP in, say, 2019 or just before COVID, and you compare where India would have been in FY25 and where it is now expected to be, there is still a 6% gap. Now, this is true for the rest of the world as well. When the rest of the world is actually maybe 1.5 years behind where it would have been. India is now maybe 0.8, 0.9 years behind where it would have been, but we're doing far better than the rest of the world despite fiscal consolidation. But the problem is we are still behind. And unlike, say, a China or a Europe or a Japan, in our case, the workforce keeps expanding. So there is 9, 12 months of extra workers in the economy, and therefore labor does not have pricing power. Now, the good thing is that on a cyclical basis, at least this gap is narrowing. So if 1 year back I had done this, when I drew these charts, there was a 7.5%, 8% gap versus the pre-pandemic path. In fact, 1.5 years back, this was a 12% gap. If you looked at consensus numbers, there was a ridiculous large gap. That gap now, with the growth surprises that we have seen over the last 6-9 months, has narrowed to now 6%. So we are improving, but there is still a gap, and that means that labor has a... So this is a cyclical problem. The faster we can close this gap, the faster this gap closes. There's also a structural problem, and this is based on economic theories of Arthur Lewis and Simon Kuznets and people like them who, in the 1950s and then in the 1960s and 70s, came up with these theories that as you move a very large part of the population from, say, agriculture to industry, for that generational shift, say for a 20-year period, you see a surplus of labor, and therefore capital, which is the owners of industry, get more bargaining power, and labor does not have as much pricing power, and therefore inequality inevitably rises. And then once that transition is over, then labor starts to grow, then the number of workers is not growing anymore, and then you start seeing labor getting pricing power again. That's called the Lewis turning point, which China crossed in 2017. So you must have seen wages there going up a lot. So we are going into that phase where historically every single economy that has gone through this transition has actually seen a rise in inequality. Now, the reason why it is particularly challenging for India is that when the other economies did so, when the UK did so, when the US did so, they weren't really democracies. I mean, they were counted as democracies, but voting power was very restricted even till about 100 years back. Even in the UK, not everyone had voting rights. When China, of course, is a league apart on that front. But we have to keep growing and sustain our growth rates, despite having to, and we have to therefore make sure that we cannot have a very incessant and a very discordant, very high levels of inequality emerging, because that is not sustainable in a democratic society. So what we need to do, and that's why it's a policy challenge, is that at all points we try to draft policies so that small businesses, small entrepreneurs, and I think the advantage that exists, so it's not an intractable problem. The advantage that exists today is that technology allows you to solve many problems. So, for example, accepting digital payments would have been very challenging when you could only have those point of sale devices with credit card readers. Today, a small banana seller outside the office can set up a QR code sticker and can accept digital payments, and that significantly brings down the transaction times, the number of transactions that you can process, the safety and security, and the time wasted in exchanges and all that. Same with credit. So if you can use new tools, a lot of data to provide credit to small entrepreneurs and allow them to scale up. So we are starting to see some of these things happen, but there's clearly a lot of work to be done so that small businesses do not naturally get disadvantaged against the larger businesses. But some amount of inequality, I fear, is going to be inevitable. For example, if you have to set up a power plant, you need someone with $1 billion, right? I mean, you cannot set up a power plant. You can do rooftop solar, you can do a lot of distributed power generation, but for industrial grade power or that bulk generation of power, you need large pools of capital. If you are investing in a battery manufacturing plant, you need large pools of capital. And I think as this investment phase occurs, there will be some inevitable increase in inequality, but the focus of policy should be to moderate it so that we don't require very vicious turns in our macroeconomic policy.
Well, as we speak, the budget isn't too far. The full year budget really isn't too far. So your budget expectations going forward?
Right. So you would have seen that in the last 2-3 years, the budget speech itself has become much shorter, much punchier, with very, very clear messaging. And in fact, I must say that the transparency and the clarity with which the numbers are presented is also improved significantly. So the thing is, we have already seen the vote on account for FY25, and given that it is the same government more or less, meaning that we don't know the people in charge, etc., but the government remains the same, so there should be policy continuity. We expect that the fiscal deficit target will be brought down for several reasons. The first is that FY24 fiscal deficit finally came to 5.6% of GDP, whereas the revised estimate target was 5.8%. So just in 3 months, less than 3 months, the government figured out that the deficit was going to be 0.2 percentage points of GDP lower. The reasons why that happened, I think, are going to persist, and that should help in FY25 as well. In addition to that, the RBI dividend, so as you know, the Reserve Bank of India, which is owned by the government of India, when it makes surplus money, it pays a dividend to the government. The RBI dividend was 1.25 trillion rupees, 1.25 lakh crores, or 0.4% of GDP, better than expected. We expect that some of that will be used to bring down the fiscal deficit target. So we expect that 5.1% could become 4.9%. So basically, lower borrowings from the government, and which should be very supportive of bond yields. We also expect that there will be some clarity. If you recall, there was a deep tech R&D program for which the government announced funding. The exact contours of that as to which ministries will get it, what kind of projects will get funded, how will the funding happen, who will control that funding. Those are questions which have not yet been answered, at least in the budget. So we saw a big allocation there. We don't really know how exactly the government seeks to fund it or how to execute it. And I expect that the budget could actually provide some clarity on that. On other issues, I think, the good thing about this government, especially in the last 2-3 years, has been that it made it very straightforward. The government has explicitly stated that now that the economy is on its own, it's recovering, it is then the fiscal support that was being given for growth should be withdrawn. And that's exactly what they're doing. So infrastructure spending as a percentage of GDP may not expand from here, though I think with some amount of the RBI excess dividend or better than budgeted dividend, they can perhaps choose to spend on a few things. There could be some things that they need to do as regards the special category status that they may need to provide to some states. But by and large, the split of the budget should remain consistent with what we saw on the board.
Top 5 investment ideas for the next few months.
So the investment themes remain pretty much the same, right? So if the real estate cycle is turning, a lot of these launches have happened. The developers have been, taking advantage of the demand for housing by announcing a lot of new launches. They need to now go and build these houses. And when those houses are built, there will be demand for cement, there will be demand for steel, there will be demand for labor, there will be demand for cables and wires, paints, eventually furniture, fixtures, sanitary ware. So all of this, remember that in most countries which are prosperous, the reason they are prosperous and we are not is that they have a large amount of what we call capital stock. Now, capital stock is a bunch of machines, a bunch of buildings, a bunch of infrastructure. Now, a very large part of capital stock in most developed economies is housing. And so as housing stock starts to get built, it creates a lot of activity, and we remain quite constructive on that front. As India's economy starts to get closer to very high levels of capacity utilization, capex is starting to pick up. In fact, our analysis shows that a lot of the challenges of investment and GDP slowdown in the previous decade, the root cause was the real estate sector. So once that starts to happen, then the whole investment cycle beneficiaries, demand for credit, so basically financials and industrial goods, all of those, I think the underlying momentum will be quite strong. How that translates into market opportunities is a bit different, because when you are doing that, you need to be cognizant of what multiples are you paying for. So a very common question in markets is what is priced in. So you will find that some company may report a doubling of profits, but the stock may fall the next day because people had already anticipated that and they were perhaps expecting under 10% growth. So the same holds true here. Some of the industrial stocks perhaps are overpricing or maybe pricing in too much of future growth too early. And as stocks, they may not be very attractive. But we think that financials, utilities, if the energy demand is going to be robust, then I think demand for power is going to be strong, and the providers of power are energy exchanges can be good proxies for that growth. So construction proxies, things linked to real estate development, or companies linked to real estate development, companies financing industrial infrastructure and real estate development, and some of the the energy proxies could be more attractive than some of the other sectors in the economy.
So is it true that domestic flows is what is really keeping India's stock market stable?
You see, remember that there is now $35 to $40 billion annually, which is a lot of money, coming in every year through what I call unintended flows into equity markets. So why are they unintended? Because, like provident fund, like your salary and my salary, a certain percentage, 12.5% goes into EPFO, and 15% of that automatically goes into the Nifty ETF. Now, these numbers are going up dramatically. So from the time this process started, where 5% was put into equities incrementally to 10%, 15%, eventually perhaps 20%, this number is now $7-8 billion a year, which is a lot of money. Then you have the systematic investment plans. These are also improving quite substantially. When there was a time when 5,000 crores was considered a big number a month, now we're talking about 18,000-20,000 crores a month, and this number keeps rising. This number is already $25 billion plus if you analyze. And on top of that, there is improving insurance penetration, and as people buy insurance schemes, certain part of those the flows that the insurance company keeps in case there is a claim later on have to be kept as part of it in the equity market. So when you add all of this up, this is $35 to $40 billion. In fact, when I started talking about this several years back, I used to talk about a 25 billion number. It has grown since then. And this is a very remarkably stabilizing force for the stock market. So at any point of time, mutual funds in India are sitting on 1.25, 1.3 lakh crores, 1.3 trillion rupees, because up to 5% of cash they can hold. And so whenever the market corrects too sharply, they go in and start buying. And that provides a certain level of stability. And I think those flows are unlikely to change, right? So people are not going to stop doing SIPs or curtail their EPFO contributions or stop buying insurance policies. So this is also a very important stabilizing force. And in many ways, this is the reason why India's stock market trades at a premium to global markets, or at least the premium has expanded. The reason for premium is also that India is a faster growing economy with much better better earnings growth. But so these trends also should provide some stability to the markets going forward. One aspect we need to be very careful about, though, is that this plumbing of savings into equities has distorted relative prices. So frankly, in my view, over the last 1 year, I've been repeatedly saying that the Indian government bonds provide much more value, maybe tax adjusted, than what the stock market provides in terms of, say, 3-year returns. Because all of these savings are going into equity market, the P multiples go up, and then the future returns then start to moderate. So we need to be careful about allocation between asset classes, but these flows are a very important part of keeping the stock market stable.
For the youth of the country, take us through your journey from being an IIT gold medalist to a top Axis Bank official. Of course, you have been talking about the AI era. Take us through the changes and the message that you have for them for the future.
The next 20 years are going to be very different from what we have seen in the last 20 years, or so the last 27 years since I graduated from college. So it was a very different world, and every generation sees new challenges. I think the next 20 years are going to be very exciting with a lot of new opportunities. India's own economy will become much more globally connected than it is right now. And so there'll be new opportunities, new types of skills, and a much more dynamic work environment where I think the ability to learn new skills, diversify into new areas, and take advantage of some of the massive technology shifts that are occurring, and the opportunities that throw up. So there's a lot of good, exciting stuff happening. India's stature in the world is much better than at any time that I have seen or have memory of. And that opens up, opportunities globally. There are countries which are depopulating, and they are looking at India for getting talent, whether it's Germany or Japan or Israel. I think all of them are exciting places to work, and a lot of good talent and good skills that can come in. So there is a lot of work to be done in India. There's a lot of work to be done globally. There are lots of new skills to be learned. Many value chains, whether it is on goods or services, are going to get disrupted, meaning they're going to change because of the advent of language models simplifying certain activities, the advent of robotics, the use of big data. So fascinating times ahead. I think being curious, being a bit more of risk-taking, meaning whether it is financial risk or intellectual risk, venturing into areas where which you would like to be part of, but you may not have ever done before. I think all of those risks are worth taking, given all the growth prospects that are ahead of. Yeah, so you see certain types of skills which are repetitive in nature, which require certain types of analytical, like for example, say even something as basic as programming. I don't think programming will be done by AI, not at least in the next several years, but eventually it may be. But programming can be simplified in the sense that what 10 people, 12 people were doing earlier would be done by 2 or 3 people. And so being aware of what are the new tools that are coming up, being aware of what are the skills that you need to utilize those tools better, and to even come up with new business models. So for example, today, even in the medical sciences, teleradiology, telepathology, that, if say the Stanford Medical School has a very long lead time in giving diagnosis on what radiology scans show or what pathological slides show, well, guess what? I mean, you can actually set up a team of 100, 200 doctors sitting in India, which can actually provide first-cut things, and they can be supplemented with AI tools. So I think being aware of of all the things that are happening itself can sometimes throw up new opportunities, and being very flexible and trying to visualize that things may be happening this way currently, but in 5 years' time, as these models keep evolving and becoming more mature, that they will learn a few things. But at the same time, I think we should be careful about all the hype that surrounds AI, meaning that there are certain ways in which these new generations. See, I mean, it was a long time back when 486 PCs were considered very powerful, but from the time I learned AI at IIT, and my BTech project was on artificial intelligence, to learning how periodically it has disappointed. So it takes big jumps, then over promises, then for 5, 10, 7 years there is a bit of disappointment. My fear is that we may be headed into one period of that. So I think AI is going to mature a lot. Technology is improving dramatically. Harder and harder problems are being attempted, but we need to be a bit careful about not extrapolating too far into the future and start worrying about problems before they emerge. So learning about what exists, how best it can be incorporated, having a bit of a timeline, 3 to 5 years, and then figuring out how best one can maneuver our own careers or maybe develop a business would be my advice on how to approach this.
Thank you for your time and this interaction.
Thank you, Sakshi.